Hello and welcome to the next in our series of videos on demystifying IFRS 9 for banks. I'm Sandra Thompson. I lead our global IFRS technical function on financial instruments and financial services. And I'm here today with Mark Randall, who you'll probably remember from earlier videos. Mark has been helping our UK banks as they implement IFRS 9. Now you haven't seen us for a while because when we first did these videos, they're very much focused around actual initial implementation and adoption of IFRS 9. But as we've got into the second year and got more into a business as usual situation, we've realised there are some additional complexities that come out. And that's what we're going to start talking about today. So today we're particularly going to talk about how IFRS 9 works when a bank does a business combination or acquires a book of loans. And you'll see there are some additional complexities that arise. So Mark, could you give us a couple of examples, please?
Sure, Sandra. So the first example I would give is often referred to as a double count of credit risk. And if I explain that, step one, when an entity is either doing a business combination and acquiring that way or acquiring a portfolio of loans, is to fair value the acquired financial instruments, and that will naturally take account of the credit risk over the entire life of the instrument. However, despite having done that, step two under IFRS 9 is then to separately recognise the initial ECL impairment provision unless an asset is purchased or originated credit impaired. And what that means is day two, you get a loss in the income statement arising from initial recognition of the stage one ECL on all the acquired financial instruments that are in scope. Now that can be quite a significant amount, and many people think that's crazy, that's counterintuitive. I agree it is. Unfortunately though, in principle, it's no different to what a bank gets when it originates its own loan off its own balance sheet. It will be at arm's length rates charging an appropriate amount of interest. But despite that, and putting the fair value on the books, so let's say par of 100, day two, it's still got to recognise that initial ECL and takes a loss. It's just that when you're in the world of a business combination, that's not noise within all the churning elements of ECL that's hitting your income statement in one go, in one quarter or one reporting period. So it's difficult to ignore if it's a big business combination.
Yeah, well, thank you, Mark. I mean, I too have had conversations with banks who just find it counterintuitive that they've already counted the credit risk in the fair value exercise and they kind of get it again through the ECL. And as you said, when you do a business combination or buy a book of loans, it can be quite a big number. And to me, that really brings out the need for good disclosures to explain what that number is and how it's arising. Okay, so that was one good example. Can you give us a second?
Sure. So the second I would talk about is around staging or significant increase in credit risk. And so if, for example, you got a bank acquiring a subsidiary of another bank, so there's an entity there. In the entity being acquired, there will no doubt be loans that are in stage two because they've had a significant increase in credit risk from the time when that entity originated the loan. However, from the perspective of the acquirer in their consolidated accounts, those loans are coming on balance sheet for the first time ever, so you kind of reset the clock and they're back in stage one if they're not credit impaired. So what that means from operational perspective is the books and records of the acquired subsidiary will have different staging with those loans in stage two compared to the consolidated picture where they might go back into stage one. So that of itself could be a bit of an operational headache. But additionally, in terms of operationalising that might have a number of impacts. So if those loans are in stage two because they're 30 days past due, if when they're acquired they're 30 days past due, that isn't a basis to put them in stage two. You need the situation to have deteriorated further, so you may well need to sort of reset or recalibrate your day count on what puts you into stage two for those acquired loans. And similarly, if part of the staging criteria of the combined group is that if a loan is on the watch list, then that goes into stage two, equally some of those acquired loans may immediately meet the watch list criteria. But again, going back to that principle that there's simply been no time elapsed in the acquirer for there to have been a significant increase in credit risk, you're going to need to somehow recalibrate how you use that watch list. So maybe you need it to move to a more severe kind of a part of the watch list before you then put it into stage two from the perspective of the acquirer. But again, a number of complexities that arise when you've kind of got the interaction of the history of the asset in the originator versus the acquirer for whom life has only just begun.
Thank you very much, Mark. I think that's two very good examples. I should just say those are not the only complexities. I think when we sat down and counted them, we got to 8. Other examples are where a loan is purchased at a discount or premium on the acquisition, because that can affect your LGD, and also different impairment methodologies. And that brings me back to the point of disclosure. I think given these complexities, it's very important there is clear disclosure, so the reader of the financial statements can really understand what's going on. And you can see from Mark's example, you kind of lose the natural trend information you would otherwise get if it wasn't for the business combination. And the other point I'd like to bring out is it's very important to understand these accounting impacts when you're actually planning the business combination. So when you're doing your due diligence, understand how these arise, what the numbers are like to be, and also any knock-on consequences. For example, is there a regulatory capital impact in the particular jurisdiction? So I hope you found that useful. Thank you very much for listening, and I look forward to you joining us next time. Bye-bye.